afternoon, everybody. It is 12:01 on Thursday, July 16, 2026. And thank you for joining us. My name is Tim Davis. I'm the founder and senior managing partner of Davis Executive Wealth. And although I'm in my 28th year in the business, this is our first market update webinar since launching our independent firm, Davis Executive Wealth, through LPL. And I'm very happy to be joined today by Jeff Buchbinder of LPL. And Jeff's going to go over his 2026 outlook, some of the things that he's looking at in the markets, what the expectations are for the second half of the year now that we are 16 days into that second half. And as usual, this format is very much a fireside chat format. So in other words, I'm going to give my market update. I'm going to take about 10 minutes for the first 10 minutes of the webinar here to update things on our end. I'm going to hand the podium over to Jeff for about 20 minutes for him to run through his thoughts and presentation. And that'll take us to the bottom of the hour where Jeff and I will hopefully have some lively back and forth, as well as Q&A for anybody participating in the call. If you do have any questions for us, please do feel free to use the Q&A function on the Zoom app or Zoom website, however you've logged on. If you have any questions otherwise, I do believe we can unmute you as well. So without any further ado, I do want to bring you up to speed on things. And thank you again for joining us on what, depending on what part of the country you're in, is a pretty fine day here in Massachusetts anyways. So, the first half of the year was definitely a tale of two halves, which I think we've started to kind of get a little used to, where you've got some extreme volatility that enters the market. We start off really well. The Iran conflict, I think, caught a lot by surprise. Oil prices obviously reacted violently to the upside, which brought the market down quite quickly into the later part of March, into the beginning of April, at which point we bottomed out and have had quite a V-shaped rebound. So that then leads us to the second half of the year and what our expectations are. I think that the volatility is obviously going to continue. I think that's apparent. The volatility has been much more limited on the downside. It's been violent and quick, but we have rebounded. And from a technical perspective, we do expect that that the summer should continue to go in the right direction, especially now that earnings season is kicked off and underway, and the banks are reporting great numbers. But that'll last for the next about 3 weeks, and then towards the latter half of the summer, as well as into the fall, you do get the market spooked in the months of September and October, which typically are challenging, especially in an election year. But post-election, we expect the market to enjoy a nice year-end rally. So the framework for the second half is that the war is back in the headlines, which most likely will present opportunities. And a lot of people have been asking us, what does this war mean, and why has it not really resulted in any downside in the market? And quite frankly, there's two primary reasons. Number one, the market doesn't believe that this conflict is going to escalate in any meaningful way, because neither the United States nor Iran would really benefit from that in either the short, intermediate, or long term. And the second is that it just doesn't appear that the U.S. would have the appetite to expand this war even further with such things as ground troops. So despite the back and forth and the rhetoric that can be quite noisy at times, the market believes that this too soon shall pass. Some of the other frameworks for the second half, we have 5 major frameworks. So the first one is wars back in the headlines. The second is that the AI story will, remains intact, and the AI story is primarily concentrated in the U.S. Korea, if anybody's been paying attention, Korea is having an absolutely gangbusters first half of the year. Taiwan, and Japan. And on the AI front, the AI bottlenecks still exist, especially in memory chips and power. Those bottlenecks will work themselves out. Later on in the summer into the fall, especially, markets usually test a new Federal Reserve chairman. So look out for that. And, I'd say that, if we had any concerns in the immediate future, it would be that margin debt levels are nearing the point where you typically see some market consolidation. It's just, people are very optimistic. They're using margin to increase their exposure to the market in a leveraged way. And that usually is a sign that things do need to cool off. The big news this week was on the inflation front. That was a better report than is probably being appreciated. Only 7 of the 108 items that go into the inflation print had positive inflation in the month of June. That was public transportation, motor vehicle maintenance and repair, recreation, personal services, and car and truck rentals, believe it or not, go into the inflation numbers. The good news was shelter costs. Shelter costs came in at 3.28%, which was slightly below the average, and 68% of the inflation basket is deflating from the peak. And that has translated into the market now predicting that the Fed will only raise rates once. It was twice. And our base case remains that the Fed will remain on hold for the second half of the year, excuse me. And if there's any chance that the Fed will raise rates, probably in November or December timeframe, mostly because this is an election year and the Fed hates to get involved in any way in election year politics. So that would be a positive. There was another release from the Federal Reserve as well, which is known as the Beige Book. That's the Fed making comments on what they think about the economy. The growth is broadening economically. The labor market is improving as well. The inflation front, as I mentioned, inflation is easing. Economic activity is being driven by capital expenditures and not the consumer. Keep in mind that about 75%, Jeff would know the exact number, of economic activity in the United States is driven by consumer spending. So that leaves only a quarter of the economic activity driven by CapEx, and that certainly has been a huge driver. The one concern that the Beige Book did note was that consumer growth is weaker. It's trending down. People are delaying purchases and increasing their use of credit. So that is something to look out for as well. But overall, we do remain quite constructive on the market. And I will say that this is a year that, more than any other years, at least since the pandemic, where a broad-based diversified portfolio is certainly paying off. And for once, large cap companies, that would be the so-called Magnificent Seven, all the big technology companies, have been taking a backseat to some of the smaller companies. Small and mid cap has enjoyed a return year to date that is over double the S&P 500. That is a sector that we've been favoring for quite some time, that being small and mid cap. That sector is more closely tied to ISM, manufacturing, which has been in recession for quite some time up until this year. Any indicator, any reading below 50 is signals contraction in the manufacturing sector, and that's been at or above 50 for the past few months now, and that is certainly going to benefit more small and mid cap companies. And of course, international emerging markets have done quite well. I did mention that South Korea has had a absolute gangbuster year. I don't know what the latest numbers are, but somewhere around 90% year to date. So it's been great for diversified portfolios that are not just owning large cap technology stocks, which have been leading the way more or less, since the COVID sell-off in 2020. So we expect that broad-based diversified portfolios will continue to do well. And the rate environment, I think obviously is a little, a little unpredictable. Rates have been trending a bit higher lately. But for those individuals that have fixed income for, clipping coupons and getting current yield, it's been a great environment. And even if we have a slight drop in rates, that would be beneficial to fixed income holders that would see capital appreciation of the portfolio through declining rates. So even if we have a sideways rate environment, it is great for the so-called coupon clipping investor. So without any further ado, that's my comments and my quick thoughts on things. Jeff, thanks again for joining us today. We're very honored to have you, and very happy to be affiliated with LPL, and look forward to hearing some of your thoughts.
Wonderful. Thanks so much, Tim. Great to be here. Appreciate the invite. And certainly want to emphasize that, I'm part of a 50 or so person research team here at LPL, and we work to support you. So if there's anything you need beyond today, just let us know. We're a resource for you. So, I was kind of hoping that I'd disagree with you more after after your initial comments, but I think you'll hear generally agreement from me. Let me make sure that I get these slides up, and there we go. You should see that now. So I'm going to go through our mid-year outlook that we
Jeff, we're
just
seeing
released.
your presenter view if you want to swap that.
Oh, you're seeing the presenter view. Okay, thank you for that heads up. Do swap presenter view. All right, very good.
Thank you.
Thanks for that heads up. So we have a pretty constructive outlook for the second half. In our mid-year outlook publication, we presented what I would call maybe a more balanced view. There's certainly some positives and negatives here. We started off the publication with four key themes. I think, Tim, you basically mentioned all of them. The election, historically, we do get sell-offs ahead of midterms and then really strong rallies after. But our view is that this is not going to be as volatile of a midterm cycle as we've seen historically, because the market is already pricing in gridlock. We could get surprised, but probably not. It's looking like the Democrats are going to take the House. And if you have divided government, the market takes out extremes. That creates less uncertainty and minimizes drawdowns around this. And we could get a drawdown in stocks around something else, but our view is that we'll have gridlock, we'll have clarity, and generally speaking, the market won't be as volatile as has been historically. The next theme that we talked about in the mid-year outlook is what we call resource nationalism. So this is just the number of export bans. Obviously, they have skyrocketed. This is like reverse globalization that we've all seen in the news, going all the way back to when US-China tensions ratcheted up back in Trump 1.0. What does this mean for investors? It means we think there's going to be a little bit of a floor under commodities, not just commodities, but actually things like chips as well, semiconductor chips, because the supply chains we're trying to move the supply chains to our shores. That is going to create a little bit more inflation. Plus, with the logjam in the Strait of Hormuz, you have some key materials that are being held up, and that is creating some stickiness to inflation as well. I'll talk more about inflation in a bit, but this is certainly something to think about. Inflation is not just going to go away as soon as those tankers start moving. The next theme is AI. Can't go through any outlook without talking about AI. And look at the ramp up here in spending. It's just massive. And I've heard a number of strategists talk about how these numbers now, based on current estimates, are still too low, even though they've gone up about 40% this year. So coming into the year, we thought these five hyperscalers would spend about 525 billion. Now the number is about 725, and it's probably going to 800. So if these analysts are right, folks that follow this much more closely than I do. So why does this matter? Well, it's driving earnings, massive earnings growth, really. and that's providing support for stocks. But at the same time, it also ratchets up the scrutiny on this investment. These companies are going to have to generate returns from all this spending, and over the next year or two, the market's going to be more demanding. So there's a balanced view of AI. We think it's going to lead to a lot of productivity. We think it's going to help companies expand margins, and we think that the hyperscalers are going to be able to monetize a lot of this investment, but there will probably be waste. There is in every cycle like this. And so that is certainly something that we have to be cognizant of. The last theme is Federal Reserve and Kevin Warsh, that transition. So Tim, you mentioned that the market tends to test Fed chairs. Hopefully we don't get much of a test here. Warsh is certainly talking tough on inflation, but he's also not giving the market as much guidance. And so that could potentially lead to some volatility in the bond market as the market gets used to his new communication style that's a little bit more closed, I guess, than Powell. But generally speaking, we think inflation is going to come down. That, of course, is dependent on oil. But the rest, actually, Tim, you alluded to this too. The rest of the components of inflation we think are starting to look pretty good. The economy is not booming. It is growing at a slow and steady pace. And that is not inflationary, all else equal. Just got to continue to watch the Middle East. So that's theme number 4. Here's just a few slides on the economy. I'll keep this really high level. Consumer spending's growing at almost 2%. Actually, there was a little bit of a World Cup boost, I think, in the June numbers that we just got this morning. So maybe there'll be a little bit of payback in July. But nonetheless, we have a pretty solid consumer spending trajectory right now. That's the light blue bar and the red bar. So this right here is consumer spending December 2026. This tells you almost 2%. That's fine. The business capital investment, which is largely AI, is pretty much everything else. So that's about 1% of GDP in terms of contribution. And then consumer spending X the drags is kind of the other half. So why is this important? Because we're probably not going to get a recession. We think recession odds are very, very low. That is consensus. We have to watch 2027, 2028 to make sure that this spending doesn't unravel. But right now, recession odds very low. And when you have low odds of recession, you get stock market gains. But at the same time, this is probably not enough to drive multiple Fed rate hikes. We could get one. Our view, aligned with you, Tim, is that we'll get a Fed on hold in the second half, and then we'll start to see cuts in 2027. But certainly growth, we don't think is going to cause the Fed to have to slam on the brakes. Here are inflation forecasts. We think after this little bump up, oil went from 70 to 80 pretty fast. After this little bump up, we think we're going to roll back over. The Fed's preferred inflation measure right now is kind of mid-3s. That we expect to get into the high 2s by the start of 2027. So again, dependent on the Middle East, but we think combination of moderate but steady economic growth and hopefully a clearing of the bottlenecks in the Middle East leads to lower inflation. And the job market's just fine. We're generating about 110,000 new jobs a month. The unemployment rate remains low. The fear monger is talking about AI taking all of our jobs. Well, that is not evident yet. Some jobs will be disrupted, but throughout history, the workforce has just reinvented itself and moved forward. And we think that'll be the case, generally speaking, again this time. At the same time, wages matter for the Fed. And if you have a little bit of an uptick in the unemployment rate, that reduces the ability of workers to negotiate higher wages. So that actually helps the outlook for the Fed as well. So let's turn now to stocks. So I mean, you have to start with AI and earnings, right? The stock market has, as Tim mentioned, done very well in the first half. Clearly, there's been some bumps. It's interesting that the gain in the stock market exactly matches the increase in earnings estimates. So 10%. So at the start of the year, consensus was somewhere around $310 in S&P 500 earnings. Historically, those estimates come down. So if the historical pattern held, we would have been at 300 for 2026, or maybe even a little bit lower. But we're tracking to near 340, which is really remarkable. So not only is there strong earnings growth, 24% is consensus for Q2, really, really strong. But we're also seeing surprising strength. And that's really, I think, what the market has seen this year, and rightly moved higher. So we got to be a little bit wary of valuations. It's related to your comment on margin debt, Tim. So there is a little bit of, I'll call it froth in semiconductor valuations, and there's certainly depressed cash flow in the hyperscalers. Right. So this is two valuation metrics. It's earnings yield. So higher is cheaper in blue, and it's cash flow yield. So lower is more expensive. That's what's happening in cash flow yields. So when you value stocks on cash flows, they're very, very expensive. One of two things has to happen. Either cash flows have to go up so that these cash flow valuations improve, or the spending has to drop. Well, probably not going to see spending on AI cut anytime soon. These companies are just going gangbusters. So what's probably going to happen is in the next 2-3 years, you're going to start to see kind of a hockey stick higher in cash flows. If at any point the market is more skeptical about that, that's where you're going to see some volatility. So we actually pulled back on tech in early June. We were overweight tech, downgraded it to neutral because, again, there's a little bit more cash flow risk, but also because of positioning. Investors, that's what this chart shows. Investors were just loaded up in tech stocks. They just own more tech stocks than they've owned in the last 17 years. And if we had data for this metric going back to the late 90s, it probably looks similar. When you get this much tech ownership, we'll say, this is institutions and retail, by the way. When you get this much tech ownership, you typically can't sustain it. And what's happened, sure enough, tech's been a bit weaker here over the last, call it 6 weeks. So we hope to re-engage with tech in the second half, but right now we think it makes sense to be kind of market weight in that, call it 33% of equities, give or take. That's the percent of tech in the S&P 500. So here's our forecast for the end of the year, 7,700 roughly on the S&P 500. If we're wrong on that, we're going to be wrong on the low end. We absolutely see more risk of an upside to that than downside to that. And why? It's because our earnings forecasts are conservative. There's just so much uncertainty about AI. We've never been here before. We've never had a, what is it going to be? $6-7 trillion build out of AI over a period of several years. Companies haven't adopted it. They're still trying to figure out how they're going to use it. There's just a lot of uncertainty. So the combination of that uncertainty and maybe some sticky inflation risk caused us to be a little bit more conservative with our earnings. So the strategists, the Wall Street top-down strategists, think we're going to be at 360 to 370. We're at 350, and that leads to our lower target than most folks. You're even starting to see some 8,000 numbers from some strategists. So that's where we're a little bit more cautious, but hope we're wrong. And frankly, there's probably more of a chance that we're wrong and too conservative there. So I'll just wrap up real fast with bonds. This is the Fed rate hike expectations right now. One hike for 2026. Look at where it was at the start of the year. It was at 2 cuts. So this is a big change. So this is really the biggest reason why We raised our yield forecast for year end. Now it's obviously related to oil prices. That's why rates are up partially or largely. But we still think that the Fed's going to stay on hold because inflation is going to start to cool in the fourth quarter. But this means that it's very hard to make a case for the 10-year yield to go below 4. So we think it's going to stay in the low fours in the second half. It's in the mid fours now. Last slide here is hyperscaler debt. So it's related to the slide I showed earlier about cash flows. The hyperscalers are spending all their extra cash flows on the AI build out, on the data centers and chips and servers and all of that good stuff. So historically, these companies didn't have really hardly any debt at all. This is starting to increase the risk in the corporate bond market. So we're fine with high quality corporate bonds. We're fine with treasuries. We're fine with mortgage-backed securities with the implicit backing of the government. But we just want to raise this as a risk. We think that there's a possibility that over the next 6 to 12 months, you do get some AI disappointments at times, and the market might get a little bit more nervous about the debt. This could also go a lot higher depending on how expensive this build out is. Memory prices are rising. That's something to consider as well. So just to watch out there, but we're still AI believers. And certainly we don't expect the market to get too nervous about this over the next 6 months. So I'll go ahead and stop there, Tim, and happy to entertain a little back and forth on any of this. Hopefully you can find something to disagree with us on in there to make this an interesting conversation. But hope you found that of interest, and thanks again for having me on.
This perfect. Thanks very much, Jeff. Yeah, I heard a comment this morning actually regarding the AI, trade and just the overall impact of what it's going to have. I think that probably one of the most popular fears of AI is the fact that it's going to eat into employment. That we're all going to go out and nobody's going to have a job anymore. And somebody had made the point that might have been Tom Lee at Fundstrat, but during the internet boom, who would have thought that 1.5 million jobs would have been created by ride sharing? Uber and Lyft obviously are the two big ones, but that's a huge number, and is part of the so-called gig economy. But there are just so many things that we couldn't even imagine go into the crystal ball of what the future looks like and what AI is going to do. And everybody had various fears about what the internet was going to do and the advent of the internet, now 26, 28 years ago, and what that, how that was going to impact, not only the economy, but society as a whole. And as we know now, it was a significant net positive. So, have you ever kind of gone down that rabbit hole and thought to yourself, how is AI going to, how could it improve the employment situation? Obviously, it can act as an assistant. I think everybody in the world now uses, some sort of either a chat GPT, to search for your so-called virtual assistant. That's one less person you have to hire, but it also makes you much more productive in trying to figure things out, especially in a fast and efficient manner. But how could have you thought about how AI could actually create more jobs and where it would?
Yeah. We haven't thought too much about what types of jobs might be created, but certainly the history is really encouraging because of the new jobs that were created. And it's not just the internet boom, that's the most recent one, right? But you can go back even further, and that was the worry back when machines started farming, right? The Industrial
Or
Revolution.
the assembly line for vehicles.
The assembly lines for vehicles, for everything else. So you can point back at a couple hundred years of history and say, well, when people are afraid that they're all going to lose their jobs to the machines. They reinvent themselves. There's going to be more services jobs. That trend has been happening for decades certainly. We certainly don't believe in the Elon Musk view that in our lifetimes we're not going to work, like none of us. That's ridiculous. And actually, another Uber story. I saw a story this morning that they're having problems with the autonomous vehicles because people are maybe having too much to drink and they're falling asleep. And then their family members can't find them or they can't, there's just or they're making a mess in the cars and things like that. There's just certain things where there will be some human intervention, even when people are worried about, well, the robots are going to take our jobs, right? But certainly we're going to have more leisure time, I think, because we're all going to be more efficient. But if you put this tool, I mean, when you put the tool of internet and mobile phones in people's hands, they became more productive, right? Communication improved, and we were just able to do things much faster and much easier. I think the same thing is happening with AI. You're going to put these tools into people's hands, and so we're going to be, I mean, some of us are going to be 5 times more productive, 10 times more productive in the work that we do. I've seen a little bit of that. I'm not going to put a number on it, but in my work, I've seen a little bit of that. We use the AI function that Bloomberg has. We certainly are using Copilot and a little bit of Claude from Anthropic. And it's really, when you talk to people who are in the know, who really develop these tools and work with them most closely, the early adopters, the enthusiasm is really, it's kind of infectious. So I think we're going to have a pretty amazing, 5 years. But man, it's hard to figure out where the jobs are going to be. We're just going to have to monitor the robots. You can't just let them go do their own thing. Not that they're going to kill us all, but you have to make sure that they do what they're supposed to do. And so there'll maybe be new sort of quality assurance type jobs, robot monitoring jobs. I don't know, drone driver jobs. But I don't know. It's really hard to predict. It's good question.
We actually got a question from a client here that this is an excellent question that, I think was kind of the talk of the morning. I don't put on CNBC or any of the financial news networks very often, but I'm sure this was on the docket, which is, what impact do you expect to see in limiting AI growth now that building data centers is a quote NIMBY problem, and the state of New York implementing a 1-year pause on data center buildouts? How contagious is that? Is that going to be impactful? What type of backlog is it going to create? Is it going to slow things down? I know, that's been a pretty hot topic that, quite frankly, I'm still scratching my head about a little bit, because the data guy in me tells me that that's stifling innovation. But any comments on that?
Yeah, it's why people are excited about data centers in space, right? With
Yep.
SpaceX. So yeah, what's interesting is this could slow the cycle and actually make the spending more disciplined and reduce the risk of waste, because it's just going to take longer for the spending to be deployed because you got to figure out where you're allowed to put the data center, right? And you got to work out, well, we want to pay for our own water and our own power, right? I think that's really what's going on in New York. So working through that's going to take time, and it's possible that this spending that people, let's say $1 trillion next year, maybe that's not quite $1 trillion, because companies just take longer than they think to actually deploy that capital and build that AI. So in a way, it's both good and bad, right? It creates earnings risk in 2027 if you don't get the spending. But at the same time, it increases, I think, the discipline and the thoughtfulness around the rollout as this, potentially gets spread out. And if there is going to be a bubble to pop, it probably can't pop in 2027. If the build out goes into 2029, then maybe you can't really pop any kind of a bubble until 2030. That's kind of Maybe that's making lemonade out of sour lemons. But everybody's waiting for when the sort of peak spending on chips is going to start to roll over. And some of those bottlenecks actually push that date out, and the market doesn't have to worry about it so much today.
Switching topics a little bit here, back to the broadening of the rally. I think that is really one of the things that's underappreciated about this market in a big way for those individuals that don't follow it. Yeah, I think it was just about 2.5 years ago, when we started to get really optimistic and super bullish on small and mid cap. We were obviously early to the game, but yeah, it was at that point, yeah, in early 24, where the delta between the Russell and say that the S&P had grown to its largest since 1999, where the valuation difference between large caps and small and mid caps just it almost couldn't get any bigger. And that was significantly lower than what it is today, and it fell to a multi-year low. And it took some time, for that trade to work itself out, but with the Russell up about 20% so far this year, it certainly is working out in the favor of small caps and mid caps. Yeah, how real do you think that is? I remember, back when we were kind of having these conversations in the late 90s, and not that it's the late 90s now, but it is from the perspective of, in the late 90s, everybody just wanted to talk about large cap technology. And that lasted quite a while. And then from 2000 to 2010, the S&P didn't do anything. It just treaded water. And in a lot of that time, it was negative, from where it was on January 1st of 2000. However, small and mid cap, international and emerging markets, well, that was all the rage. That's where the easy money was, anywhere from, high single digits to mid-teens. And if anybody remembers that from back then, you had the so-called BRIC countries, Brazil, Russia, India, China. And so now we're kind of starting to see a return to that. It's been what, about 15, 17 years since international and EM really were worth even mentioning. And I know I'm a very big fan of Jeremy Grantham's so-called reversion to the mean. And if markets always revert to the mean, which mathematically they have to, doesn't it mean that we could be in for a really, really good run here for the next 5 or 10 years with asset classes outside of just large cap, and specifically US technology?
Sure. Oh, absolutely. We're believers in that too. We upgraded small caps in the first half, and we've kind of bounced between neutral and overweight international for the last year or so. We're neutral now, but that gives you a decent chunk of exposure. We just needed to wait for the Mag 7 to slow down a little bit, right? Because
Yeah.
when the Mag 7 is dominating, nothing else can keep up. It's just too much market cap driving the US higher, driving the large cap segment of the US higher. But these cycles tend to go 7, 8, 9, 10 years, right? You just cited a few that did that. So
Yeah, they're secular.
they're secular, absolutely. So there's reason to think that international could be in for a good period. I mean, the problem is the dollar is strong,
That's
right?
that was going to be my next comment.
That's
Yeah,
one problem.
we,
And
we, we need we need a stable to weak dollar for that to happen.
that's right. That's one challenge. And then you mentioned Korea, right? Korea and Taiwan have just been moonshots. And so we're not really thrilled about buying those markets right now. So you'll get ups and downs. But just in terms of um, who's going to benefit from AI, emerging markets will. There's a ton of AI in EM. In fact, EM, the index for emerging markets, is as much AI as the US market is right now, which might surprise people to hear. So if you're going to think that AI is going to be revolutionary in the next 5 years, then you want to be in EM, no doubt. And Japan is certainly benefiting too, big players in tech and robotics and things like that. The challenge for Europe right now is that they don't really have the tech and AI so much, and they have a problem in the Strait of Hormuz. So as long as they can get their energy, and as long as they can keep up and be productive with the ramp up in AI adoption, then Europe should be fine too. But just being cheap is not enough. You need a little more than
Yeah,
low
it's been
valuation.
cheap for a long, long time,
Been
and
cheap for a long,
that
long
hasn't
time.
served
That's right.
anybody well.
Yeah, and
Yeah,
you also know that PEs matter for long-term future returns. So a low PE now probably means that returns in international will be pretty good over the next decade. And as you alluded to with the January 2000 date, PEs in US stock market is high. PE is high, so that means probably lower returns over the next 10 years. Now, AI may help generate stronger earnings growth and maybe offset some of that headwind, but over the long term, valuations are predictive.
and just backing up to your earlier comment, just to clarify for everybody, that the so-called Mag 7, which I think everybody, that's a very popular term, but it's the seven largest technology companies in the S&P, which comprise about 35% of the S&P. So that if you're buying the index, you're basically buying those seven companies, and you're going to live by them and die by them. And that works until it doesn't. And it's been a great run, and hopefully that will continue. Certainly where all the attention is going, but there are other places that you can make a pretty handsome profit as well. The one thing I did want to comment on, another kind of news story this week that I was reading about this morning was the earnings from IBM. We all laugh about IBM because I think everybody forgets about them. But IBM was actually on the cutting edge of AI, before anybody even knew what the term AI meant. So they're a pretty significant player there, and they had their worst day ever this week, down 25% one day. That exceeds, the drop they saw on so-called Black Monday in 1987, which I was surprised to hear. Yeah, but if you dig into that, not that we're company specific people here, neither one of us it would appear, but yeah, the reason why they missed is because people are buying their hardware, not the software. The numbers themselves and the so-called or earnings warning, shortfall, whatever you want to call it, it was not nearly the disappointment that it appears to be. And it was just that one segment did better than the other, and it was the other segment, the services and AI that didn't meet the expectations, and the market really crushed them. Did you happen to look into that at all, or any comment on what that might mean for some of these bigger companies where, as you pointed out, we are kind of priced to perfection in a lot of these companies. The overall market, the surprising thing is that price to earnings ratio, because of the earnings growth, is at or below where it was at the beginning of the year, even though we've had, about a 10% year so far in the S&P. It's kind of counterintuitive there, but I think the IBM thing might be, indicative of what happens to companies when they don't meet lofty expectations. And I wouldn't put IBM in that nosebleed, category of, the earnings multiple and where it's trading now. Any thoughts on that?
Yeah, I thought, well, you hit the nail right on the head there. High expectations punish misses. I just heard an analyst talking about it this morning, and they said that they were just totally caught off guard. There was no indication that they were going to miss in that area. And clearly the AI and the software is the area that people are most focused on. So that I agree with. What was most interesting to me was that the cybersecurity stocks actually rallied. So they said that essentially, and IBM was indicating that people are so worried about cybersecurity now, they're kind of pushing aside some of their other spend, or
Mhm.
that's causing them to reconsider projects, and they're delaying them or pushing them out. Um, the space was different, but I started my career covering that space. IT services contracts. IBM is a big services provider, and the Accentures of the world do that too. So when projects get pushed out, they often don't come through. So I think the market is rightly concerned, but it highlights just the shifting in spending patterns within tech, right? People are worried that AI is going to eat software and that all the money is going to go into chips, right? So you've seen really strong performance this year from semiconductors, a lot of weakness in software that's starting to reverse.
Yeah.
Probably went a little too far because a lot of these companies and software companies like cybersecurity players are mission critical, right? You're not going to
Funny thing
just trust
is that
an AI
the
bot.
software trade, I remember, again, I think Tom Lee's group, who I follow very, very, very closely. In April, software valuations fell to lows not seen since 2008. And I thought that was quite eye-opening. And they've recovered, yeah. If you look at one of the software, leading software ETFs, yeah, I think it traded somewhere in the mid 70s and now it's the low 90s. So we've definitely bounced, but they're still, they're getting taken out to the woodshed, and they're if you believe that there's still going to be a software sector, and I think we all do, that the opportunity that opened up, could be an interesting one going forward. Again, we're not kind of sector people, but I just thought that was an interesting tidbit. That opportunities still do exist in this market. Even though we've had this unbelievable run, going back to 2008, going back to 2020. If you look at the run since 2020, a third of the stock market gains made in the last 30 years have occurred in the last six. So we're in a very unique market, in a lot of different ways. And there are reasons to be concerned, and there are reasons to be optimistic. The optimism, I think, outweighs the concern. I think it seems to be that way with the two of us. But good old-fashioned diversification, that helps to really reduce an individual's risk and how much they might be exposed to a down market that eventually obviously is going to take place, but when that remains to be seen. So well, we're at 12:48. I don't see any other questions coming in or any other hands being raised, so I guess we did a good job of running through our thoughts on things. But again, I really do appreciate your time, Jeff. This has been a great opportunity for our clients, for our practice. We're very excited to be affiliated with LPL. We're very excited, to have an independent practice here and take advantage of times like this to update people. And if any clients have any follow-up questions that might come to mind, that even when you log right off, you're like, shucks, I guess you would have asked that. Please feel free to send me an email, and I can either answer it myself or I can forward that question to Jeff and get his answer as well. So thanks again for everybody's time on what is a beautiful day here in New England. And until next time, we'll try to maybe have one more of these before Labor Day. If not, definitely in the month of September with more to follow. So thanks, Jeff, for your time. Appreciate it.
Thanks so much, Tim. Thanks, everybody.
Have a good one. Bye.
You too. Take care.